As the second anniversary of Ireland's banking guarantee approaches, uncertainty about the future remains as fears of national bankruptcy grow. Part 1 of Freefall traced the origins of this crisis back to the deregulation of global finance, which let banks get too big to fail. Now the story of how the global became local, when the biggest credit and property bubble in world history was created in Ireland.
The reality is, we got ourselves on top of that precipice, and we were never going to be able to get ourselves down without a serious fall.
Before the fall, voices warning that it would end in tears weren't heeded.
Anyone who tried to say that the emperor had no clothes was shouted down.
History is littered with economic disasters like this, yet they just go on happening.
The world's been marked by booms, bubbles that broke since the beginning of capitalism.
This has happened so many times that you'd have thought we'd learned.
A great many were enticed by the illusion, but center stage were developers, bankers, regulators, and politicians. And when the lessons of history were forgotten, the country was propelled into free fall. Ireland today is a very different place from the boom times, as a decade of economic growth has been turned on its head.
The collapse we've seen in the economy and the financial system is the biggest collapse that has ever occurred in Irish history.
Earlier this decade, Ireland had been part of an unprecedented global property bubble, where house prices in many countries went crazy. But prices here had risen faster and higher than anywhere else, producing a dangerous property bubble without compare.
That was unsustainable. That was a bubble that was going to end in one way or another.
Bubbles by their nature burst, and when Ireland's did, the results were catastrophic. But current and former members of the Fianna Fáil government differ hugely on how much of the blame is theirs and how much is down to international events. The Minister for Finance, who's dealing with the fallout, and the former Taoiseach, who presided over the boom years, disagree fundamentally.
We had a very hard landing because we became too dependent on construction as the main motor and engine in the economy. And that's a key mistake that was made on the economic policy side.
No, that's not the reason. I mean, the reason we had a hard landing is because of we're back to what earlier on, which I haven't dwelled on, but we're back to the international position. Like if Lehman's didn't collapse, then we wouldn't have had a hard landing. What we needed to do was to get a few years break where we could get a soft landing. And because of the international situation, we didn't get that, which blew a bubble that we would have otherwise probably would have got away with.
Our decline in economic activity was something like 4 times what has been experienced in other European countries. That gives you a rough indication of the degree to which the damage was homegrown.
Ireland's bubble was so large that it was going to burst at some stage, and when it burst, it was going to cause a hard landing for the economy, and it was going to cause problems for Ireland's financial system.
Ireland's property bubble developed when construction replaced exports as the driver of growth after the Celtic Tiger economy slowed in 2001. For a bubble to form, a unique set of circumstances had to intersect. First, Irish banks needed a lot of money to lend, and they got it easily from global markets, and cheaply too, thanks to Ireland's membership of the low-interest euro.
Given the small size of the Irish economy compared to the total size of the Eurozone, Irish banks had effectively an infinite amount of money available to them to lend out.
Interest rates come down, interest rates practically halve when Ireland decides to join the euro.
Now into this heady mix of easy money, another ingredient was added that would tip the scales. the entry of Britain's most aggressive lender to the Irish mortgage market.
In 1999, the introduction of Bank of Scotland into our market had a dramatic effect in terms of how banks behaved.
Bank of Scotland Ireland came in with, with trumpets blazing, and they were welcomed here. Everybody, the media, the press, the consumer associations, all welcomed their entry. The problem was the competition actually got out of hand, and it went overboard. It kind of flipped from being a very welcome attack into getting utterly excessive.
By aggressively offering cut-price mortgages, Bank of Scotland posed a dilemma for the local lenders. Maintain prudent policies or throw caution to the wind. They chose the latter.
You have a decision to make. Do you follow the competition or not? Do you allow somebody who's essentially a suitcase banker to come in and take your business? And at the end of the day, that's the decision that the Irish banks made, that we had franchises and we were going to protect those franchises.
The Irish banks, in responding, had to bring their interest rates down in order to compete with Bank of Scotland. So obviously they were earning less money on their mortgages. The only way to increase the profit that they were making on mortgages was obviously to lend more money.
And the way they lent more money was simple. They just made it easier for people to borrow. Some banks gave 40 years to repay a mortgage instead of 20. Others lent 8 times salary instead of just 3. A ferocious mortgage war got underway. And in the final assault, 100% mortgages were introduced by First Active.
Immediately on one bank introducing 100% finance, suddenly you had 6 banks offering 100% finance. A year after the product was introduced, 33% of all first-time borrowers borrowed 100% finance.
The effect was devastating. And by the way, it wasn't just 100% mortgages. It was 110% mortgages. It was 120% mortgages in some case. And this was a sign of the banks going absolutely bananas.
If you think of all the times when people were told to tighten their belts and be very careful about what they did and how they saved, and that changed, particularly with the idea of people having money thrust upon them. That is not something that Irish people were used to.
100% finance allowed people with no chance of buying a house to get on the property ladder. But if their circumstances changed, defaults and repossessions would follow. It was a concern raised at the time with Brian Cowan.
Well, I remember asking the present Taoiseach, then Minister for Finance, are you not worried about the number of young people who are getting themselves into debt, being thrown 100%, 110% mortgages by the banks? And he just looked at me and he said, listen, he said, if people want to buy houses, it's not my job to stop them.
What I'm saying is, I don't want to see any interference in the property markets. I don't see any. My job is not to interfere there. Okay, I don't say any more about it.
Now, on top of all this cheap and unregulated credit, yet another ingredient was inflating Ireland's property bubble: government tax incentives. One in particular had helped set the bubble in motion. It was 2002, and Finance Minister Charlie McCreevy reinstated tax reliefs for property investors, reliefs he had withdrawn earlier to cool rising prices.
They came under pressure, the government, from estate agents, from property developers, builders and so on. Everybody who had a vested interest in rising prices put pressure on the government. And what happened? The government caved in.
The entire industry were saying, if we don't get our tax reliefs back, there will be no houses built.
That was the most catastrophic error that was made during the entire period, because what it did was it inflated the property bubble.
I don't accept the point at all that was a mistake.
And official policy also favored less regulation, not more. And competition was supposed to benefit society, not do damage. So when the government didn't intervene in the mortgage market, yet subsidized developers, the Irish bubble grew to historic proportions.
There was an excessive amount of capital put into the market, an excessive amount of competition put into the market. And, with hindsight, what it was like putting, a blowtorch against a can of petrol.
Bankers were supposed to apply foresight in managing risk. That's what they were paid for. But it took others to see the dangers ahead. It's 2003. One internationally renowned economist points out that Ireland's property market is rapidly overheating, making a crash almost certain.
We started collecting house price data for about 15, 20 countries. And never before in history had you seen house prices rising by so much in so many countries simultaneously. If you look at all the various measures that we were looking at internationally, Ireland was flashing alarm bells across the board.
Pam Woodall published her findings in the influential magazine The Economist in 2003, saying Irish house prices were already 42% overvalued. But her warning was mocked as prices kept rising, fueled by bank lending.
The amount of lending that Irish banks were doing for property exceeded 50% of all their lending in 2003 for the first time. So there are indicators there which would suggest that 2003 was really the time when it was beginning to get out of hand.
There were danger signs from about 2003 onwards, and then more and more signs flashing danger. But when you see a lot of lights flashing together, there is likely to be a high potential for trouble ahead.
One Irish economist spoke out, but he was very much a lone voice.
The Irish housing market is a scam. It is an enormous financial swindle that could potentially confine an entire generation of young Irish workers to years of bad debt.
Nobody wanted to hear any negative comment whatsoever because everybody was making money out of this bubble. I mean, you had the auctioneers, you had the solicitors, you had mortgage brokers, you had banks, newspapers, TV. Everybody was making money out of what was going on. So everybody had a vested interest.
What should have happened is people should have paid more attention to the early warning signs in the housing market. If policy measures had been taken much sooner, a softer landing would have been possible.
Instead, the bubble was allowed to grow, and with it the sheer desperation of people to get on the property ladder before they missed the chance. By the mid-2000s, the mortgage wars had been in full swing for 5 years, and Ireland was in the grip of a property craze.
Irish people want to own their property instead of renting it. And it's often drilled into people from a very young age in Ireland. There's no point in renting, it's money down the drain. You've got to own your own property.
So the desire to buy property, it became fever pitch. People felt if I didn't buy today, it was going to be 10 or 20,000 euro more expensive. Next week, it was going to be 100,000 more expensive if I waited 12 months. So the desire and the compulsion was evident on the streets.
We had stories of people queuing for 2 nights to put their name onto properties at very exorbitant prices. One part of a development would go on the market, would sell out within minutes. Suddenly the developer would turn around at 100,000 onto the price of the property. People were prepared to pay it, and unfortunately the banks were prepared to give people the money.
There was no fear there among a young generation to borrow money, whereas other generations would have had the opposite view.
Yeah, it's been a really strange day. I don't know. I woke up this morning and didn't think I'd have a house, but I went to bed. What have I done?
The more people borrowed, the more they could bid for property. So easy loans were driving prices higher, which in turn meant the banks could lend more still.
You went out in the morning and saw a property valued at 300,000, and you had had a meeting the previous day with your banker, and they had said, well, we can give you 350,000. The first thing you're going to do is the next day is when you go to buy the house is go to the maximum amount you can borrow.
And one thing encouraging people to borrow so freely was a false assumption that prices would continue rising. A defining feature of bubbles throughout history.
People see prices going up, they come to believe that they will go up forever and ever. There's almost a kind of frenzy that develops. And you saw that in bubbles all over the world.
There hadn't been in the US or Ireland or other countries any major drop in home prices within modern memory. And so it just didn't seem real to people, and they believed it couldn't happen.
Eventually, reality dawns. When people realize prices have risen beyond their ability to pay, they simply stop buying.
Traditionally in this country, the average house price would have been 2.5, 3 times the average salary. You know, by 2006, we had gone to about 11.5 times the average salary.
When we see this huge departure between house prices and what people are earning, we know that something is going badly wrong.
But unfortunately, you know, when you are in that type of bubble situation, very few people can stand back and actually look at it rationally and say that this thing is fundamentally unjustified.
In a bubble, it's hard to challenge the complacency that comes with consensus. But some did. It's 2005, and in her latest research, economist Pam Woodall claims that Ireland's bubble has now grown into the biggest the world has ever seen. In November that year, she came to Dublin to debate the issue at a major property conference.
There was a debate between myself and an Irish economist. I was arguing the bubble is soon going to burst. He was arguing, no, there's going to be a soft landing. At the end of that meeting, I asked for a show of hands across the room, and an overwhelming majority, maybe 80, 90% of people in the room said it's not a bubble and there will be a soft landing.
By now, the construction industry had come to dominate the Irish economy, accounting for 23% of the nation's annual wealth, double what was sustainable, and still boosted by government tax policy.
It was very difficult throughout the political system to get acceptance for the proposition that you can overheat the construction sector in Ireland. And we had a huge cultural propensity towards building property. So when we got a real opportunity to do this, we serially engaged in it.
And as prices still went on rising, those predicting a crash were ridiculed again.
Everybody said that we're going to see a huge downturn in 2005, linking into 2006. They were entirely wrong. And really, we should have an examination into why so many people got it so wrong. My view is there's not a great problem.
If anything, the fact that prices had become more overvalued than they were a year ago, that actually means that the dangers of a bubble bursting are even greater.
If action had been taken then to restrain further growth, the serious damage that was done by the ultimate crash could have been reduced.
Without government restraint, the bubble just got bigger, and in the front line were Ireland's builders and property developers. In the bubble years, Ireland's developers became celebrities, with flamboyant lifestyles and all the visible trappings of wealth. But they also employed tens of thousands and built much-needed infrastructure.
By and large, developers are a very hard-working, grounded group of people who have generally built up their businesses from scratch. The nature of developers is to put their chips back on the table and keep going.
The property developers became the iconic figures of the boom in Ireland. So we defined ourselves as a nation that did property development, and that was inherently unstable and was always going to lead to a ferocious crash.
We all thought somewhere there were people sitting in an ivory tower figuring out the bigger picture, and whilst we all got on with the game in hand. The banks were the fuel for the property economy. Let's nobody have any doubt about that. But we never asked the question, could the bank afford to give us the money?
Every loan is a two-sided affair. There is a banker and there's a borrower. And in this case, the borrowers were equally reckless.
The developers weren't just working in Ireland. Some were building international empires, and the way they were viewed when they descended on London gives an insight into the dangers they were courting.
The problem that the Irish had is they called it a property game. Everywhere else in the world it's called a property industry. It was a game, high risk, high stakes, double up your bets, throw the dice again, bid again, buy again, and keep flipping and selling your assets.
Irish developers snapped up trophy properties in London's West End, Canary Wharf, the City and Knightsbridge, outbidding oil sheiks in the process. But the difference was, the Irish money was borrowed.
You have to learn to control yourself. Just because you can get 500 million to buy a property doesn't mean you should.
Back home, the aggressive pursuit of big deals with speculative bets was nowhere more evident than in the race to redevelop Bowles Bridge. First out of the traps was Sean Dunn.
When Sean Dunn made the bid for the Jury's Hotel site in 2005, that was the one that really got the country moving, I think. A sense that these people were invincible.
Sean Dunn paid a record €53 million an acre for the hotel site, without planning permission for his massive project. But soon rival developer Ray Grehan had paid $87.5 million an acre for land nearby, followed by David Daly with $122 million an acre for Franklin House. In 18 months, land in Bowles Bridge had soared 150%. Making it the dearest land in the world.
No financial conditions exist where the most expensive land on the planet is situated in Dublin 4. Yet, there always seemed to be people willing to bet on these price levels and banks willing to lend them money to do so.
It was almost a sign for these people of their manhood that they had paid 400 million instead of 300 million. And it didn't matter whether the thing was actually only worth 50 million. All of it's based on a magical belief that you can't lose, that this is no longer even a gamble, that actually this game is so rigged in your favour that it's just going to keep going up and up and up.
It wasn't in our interest at all to drive prices. People thought, oh, we wanted the max price for everything all the time. Not at all, because the more we got for houses, the more we paid for land. The more we got for a factory or an office, the more we paid for land, the more we borrowed. So we were chasing ourselves, really.
Financing sites way over the odds was what eventually broke the country's banks. The government had let it happen, and only late in the day asked, was it sustainable?
I remember one day distinctly at a meeting of financiers asking the question, was there risks about this? And the answer was, you shouldn't be worrying yourself, Taoiseach. If there's somebody there to buy a site at that level, if there's somebody there prepared to build a site at that level, and if there's an end user prepared to take the site at that level, that's the free market working. And in other words, was stay quiet, Taoiseach.
As the market was left to itself, and Ireland's property bubble neared bursting point, the speculative deals just got bigger. Instead of repaying loans to banks when one project was finished, many developers simply rolled their loans over into the next big bet.
It was kind of like a roulette type situation going on with the banks and with their biggest property developers, where they would provide a loan. That loan would come due for repayment, but the banks would say, well, listen, hang on to that.
Banks were allowing the developers not pay back that loan, but effectively roll it over to the next development site. So it again made it easier for developers to buy land, more land, more land, more land, and paying crazy money.
Rolling over loans meant that when the market crashed, the developers' debts were enormous. Debts that became bank losses, paid for by the taxpayers. And ironically, by not repaying their debts when they could have done, the developers themselves had avoided paying a great deal of tax.
If the developer didn't use the profits from one development by immediately reinvesting it in the purchase of land somewhere else, they would end up paying tax on it. So the way to avoid tax was to go and buy something else. So developers were actually competing with each other to buy things to avoid the payment of tax.
In the end, 26 billion euro worth of bank debt that was transferred to the National Asset Management Agency was accounted for by just 20 developers. Their errors have landed the taxpayer with a massive burden.
We made mistakes in terms of buying sites and borrowing money at levels that in a very short time became unsustainable. This is not a situation of forgetting what the industry did. This is a situation of accepting we've made mistakes, and by God, we have made mistakes, but so have many others.
I think maybe they weren't wise in some of their commercial decisions, but lots of other people weren't wise in commercial decisions either. And I don't go with the thing of just dancing on their graves.
The developers may have gambled and lost billions, but they were cosseted by government and bankrolled by Ireland's powerful financial establishment. In the mid-2000s, Ireland had the biggest property bubble in the world. Some had predicted disaster but weren't heeded. In a bubble, it seems nobody wants to hear bad news. When the bubble burst, the banking system went into freefall. Banks are private companies, but unlike other businesses, if they are run recklessly and crash, the damage they do will reverberate far beyond their own doors.
There are some people who clearly didn't know what they were doing, or were prepared to turn a blind eye, or even worse, were flying by the seat of their pants. And whilst in other businesses that would have been bad for them, the trouble is with banks, it's bad for everyone if that happens.
So you had a culture of recklessness in banks around the world, which expressed itself in different ways. In Ireland, it expressed itself through an oversupply of credit for further building and construction, which was not sustainable. That's where the recklessness happened in Ireland.
Like any executives, bankers aimed to maximize company profits. Profits they earned from lending money. They had access to limitless funds globally and plenty of customers at home to lend to. So the banks grew rapidly, and their profits likewise.
There was so much money being made. If you imagine a country going through the property boom that Ireland went through over that period, if you're a banker, you're not going to run away from that. You're going to embrace it, you're going to encourage it, and you're going to try and make as much money as you can off it.
They grew their profitability by taking bigger and bigger risks, but they took risks which they must have known in their heart of hearts were not sustainable, that the good times couldn't continue to roll.
Banks have share prices which are dependent upon growth, and they get seduced into pursuing growth at the expense of prudence.
In 8 short years, bank lending on property soared 20-fold. And by 2007, property accounted for 67% of all lending by Irish banks, a completely unsustainable level.
Suddenly you had a concentration of risk, or all the eggs in one basket largely. So the thing that gave the lift to the economy and the lift to the profitability also became the biggest risk, and ultimately proved to be the downfall.
They were bank mistakes. There was bank errors, bank decisions, bank regulations, and when we asked about those, we got the glossy answers that they were running their business well.
As the government averted their gaze, senior bankers themselves had a personal incentive to keep lending the money that was inflating the bubble. The more they lent, the higher the bank's supposed profits. And the higher the profits, the more the top men got paid.
Who gains from the profits in the banks? The bankers. They make huge sums of money. And nobody really wanted it to end because it was going so well.
The profits in the end were an illusion because so many loans turned to bad debts and were shifted onto the taxpayers. But the bankers had already been paid. In 2006, AIB's Eugene Sheehy got nearly €70,000 a week. In 2007, Brian Goggin of Bank of Ireland earned $80,000 a week. And in 2008, David Drum of Anglo was paid a record $90,000 a week.
You're getting bonuses of $2 million a year. That by international standards, those are big bonuses. For a small country and a small bank, they're utterly excessive.
Bank bosses weren't acting entirely in a vacuum. Powerful institutional shareholders were constantly urging them on.
Shareholders are the ones who are supposed to keep check on bank managers and stop them doing crazy things. However, they were actually pushing the bankers to keep earning more and more money, even without looking at the consequences of that or the risk created.
The banks ceased to think of themselves as being custodians of people's money and started to think of themselves as players in this huge game where vast profits could be made through property.
The banks had lent billions, both for the property boom and the lifestyle it demanded. But the other side of lending is debt. And now the times have changed. The debt remains.
People go on about America's borrowing binge. In 2006, America's total debt across the whole economy was only 300% of GDP. Ireland's was 700% of GDP. You know, Ireland had a huge credit binge.
Banks provided the money, and had they not done so in the volumes that they did, you would not have had the level of crisis that you are faced with today.
It reminds me of a drug pyramid, actually. That credit was the drug, and at the very top sat the big banks, but they peddled this drug at every level, down to the very bottom of our society.
The evidence is that the beneficiaries of the way banks in Ireland have been run are the bankers, and they've been run for the people at the top themselves. And I don't think there's any doubt about that.
The big three banks, AIB, Bank of Ireland and Anglo, made nearly €15 billion in pre-tax profits in the 3 years before the bubble burst. And when the crash came, the public had to bail them out because none of the banks had enough capital and reserve to cover their losses.
Our banks, in fairness to them, I think played their part in building up the economy, but their difficulty was that things got too big for them. They started using the wholesale banking system. They were not looking at their capital adequacies. We didn't realise that. While I was Taoiseach of the country, and many people say, yes, you should have known that, I didn't know that.
Mr. Ahern didn't know the banking system was on a knife edge because his government's policy was not to ask. Unhindered, the banks had placed a massive bet on the property market. Now the good times were running out, and the warnings of trouble ahead were coming closer to home. It's 2006. Earlier warnings of a property crash were dismissed because prices kept rising. But now the housing market really has slowed down. Yet many still insist it will cool slowly, not crash.
I don't think there's any signs that the property market's going to blow up anytime soon.
Property prices have continued to rise.
We don't foresee a crash.
We are looking at a soft landing.
One senior economist begged to differ.
People said there was going to be a soft landing so often that I started to become suspicious. And so I started to look at other economies which had had big housing booms And in every case, what I found was that a big boom is followed by a big bust.
When Morgan Kelly's prediction of an imminent property crash appeared in the Irish Times in late December 2006, it was largely ignored.
The one exception was Bertie Ahern, who, as you may remember, appeared and wondered in public why property pessimists like me didn't commit suicide.
Sitting on the sidelines or on the fence, cribbing and moaning is a lost opportunity. In fact, I don't know how people who engage in that don't commit suicide. And of course I apologise for using the word suicide immediately after that. But what I was saying is that we shouldn't be talking yourself down. I say that still today.
Economists were dismissed in an extraordinary way, almost with contempt. The idea that they were being unpatriotic, the idea that they were talking down the economy, which became one of the most hackneyed phrases in the noughties. Don't talk down the economy. It's not a question of talking down the economy. It was a question of them looking at the facts and the figures and the cycles and saying this is going to end in absolute trauma.
Some economists may have agreed with Morgan Kelly, but others didn't.
I should have been a better student of history, because history shows us that we've never seen a bubble of this magnitude that has not ended in tears. But we believed, a lot of us believed, that this time it is different.
Such hubris is another common feature of bubbles everywhere. A belief that somehow the rules of boom and busts no longer count, that history itself can be defied.
And we see this, whether this is, tulips in 17th century Holland, or the internet boom, or commercial real estate in, Ireland at the height of the boom. People start telling stories. And the great phrase is, this time it's different. The new tiger has broken the rules of economics and they no longer apply. The four most dangerous words in financial markets are it's different this time, and that's what people tend to believe once the memories of the previous crash wear off.
As soon as people start arguing this time is different, usually it means that you're getting pretty close to the bubble bursting.
In predicting the property crash, Morgan Kelly wasn't entirely alone. There were TV documentaries. George Lee's Boom, David McWilliams' In Search of the Pope's Children, and Richard Curran's Future Shock Property Crash. But why did so few economists speak out?
Many of the non-academic economists are employed by the financial sector. The one thing they're unlikely to do is to write something that says that this entire system, from which I gain my employment and my income, is inherently dangerous.
There were Jeremiahs on the outside warning us like prophets of old, but by and large the consensus in Ireland in that era was, things are going well, let's hope this continues.
With such a powerful consensus, there was one final line of defense for the public.
The only thing we could have relied on would have been a strong central bank or financial regulator to say, hold on a minute, this is not working, this has got danger written all over it.
But this critical piece of the jigsaw was missing too. The central bank's job was to mind the stability of the overall economy, while the financial regulator minded the banks. In a period when reckless bank lending was not just inflating a property bubble, but putting the entire economy at risk, the need for strong minders was never greater.
When you allow a bubble to grow the size of the bubble in Ireland and in many other countries, it is almost inevitable that there will be a hard landing. And that's the reason that it's so important for regulators, as they see the bubble grow, to try to deflate it.
Just when everybody's enjoying the party, the central banker should come and take away the punch bowl.
The calamitous state in which the Irish economy and the Irish financial system now finds itself is hugely down to the failure, total failure, to regulate the banking system properly.
There seemed good reason to regulate the banks properly. AIB had to be bailed out 25 years ago, thanks to its reckless insurance business. And in the 90s, Irish banks were exposed for their involvement in the multi-million-pound dirt tax scandal.
We had had a refusal to learn the lessons of those scandals. In fact, rather than saying, you know, these people will behave quite badly unless we regulate them, we actually said, no, the really important thing is to regulate them less. And that had absolutely fatal consequences.
Ireland was not alone. Light touch regulation came from a view widely accepted among policymakers that banks should be left to handle the risky business of lending money without the authorities putting a limit on credit.
In an environment in which most regulators and most policymakers had begun to believe in the effectiveness of market participants, then imposing these arbitrary limits would have seemed like an intrusion in the free market system.
The doctrine in central banking used to be that the role of the regulator, the central banker, was to take away the punch bowl before the party got too rowdy. In the new doctrines of the free marketeers, the punch bowl was refilled.
The regulator had the power to curtail bank lending and cool the property market, as well as information to identify the problems in the banks. The Taoiseach of the day says if it was a resources issue, they should have come to him.
I mean, I have to tell you, the regulator's office never looked for a meeting with the Taoiseach of the country in all these years. Never once. And I had everybody looking for meetings with me. The regulators were never in. And if the regulators had looked, as we always did, as a former finance minister, they would have got absolute control and strength from us.
What would have happened if the regulator had imposed controls on lending? Would the government have objected? I would be surprised if they had, but I would have been surprised if the regulator had proposed it in the first place. It was so out of kilter with the whole consciousness of the country and of the political system and of the government at the time that it would have seemed very unlikely.
You could say that the regulators were asleep at the wheel and they could have done more to stop it. In practice, the regulators take their cue from the politicians. If the politicians want a light touch or no touch regime, then that's what the regulators give them.
The absence of regulation of the banks in Ireland was not an accident. It was policy. This wasn't just the fact that the regulators didn't do their job. In fact, in many ways, the regulators were doing exactly the job they were designed to do.
Light touch regulation had let the banks pump up the property bubble amidst warnings that it was bound to burst. But up to now, no one had pointed out the frightening consequences for the banks. It's September 2007, a full year before the government acknowledges a crisis in the banking system. Morgan Kelly has returned to the fray with his most ominous warning yet. Ireland's banks are now in desperate trouble.
They had lent huge amounts of money, about 110 billion euros, to developers. Once houses stopped selling, builders wouldn't be able to repay these loans and banks would sink.
When Morgan Kelly outlined this scenario in the Irish Times, he drew immediate fire.
I had a call from a senior manager of Anglo-Irish Bank who basically yelled at me, said what I was saying was entirely responsible and to shut up.
Morgan was one of the very few people who actually stood up, and it was very, very unpopular from a business perspective, from a political perspective, to say the things that he did say.
Effectively, what I had discovered was that there is an omerta, a code of silence in the upper reaches of Irish society, and that I somehow had violated this.
What was surprising was that his projections were not taken seriously by the people who had access to the data, or who should have had access to the data, to allow them to say, wait a minute, this is a serious guy, is he right?
They were deaf to the warnings because their ears were stuffed with money. And this is what happened in this country. And all the vested interests wanted the whole thing to go on. because they were making a fortune.
With the property market in rapid decline and the banks facing ruin, developers, regulators, and bankers had all played their part. But none of them were in charge. That role fell to the government. When bubbles develop in any economy, ordinary people can be swept along, but they might expect their politicians to protect society at large from disaster.
It's not the duty of the politician to stop adults from making mistakes, but it is the duty of the government to provide a certain environment in which mistakes are a lot less likely to happen.
It's their job to provide some adult supervision. And in this case, they didn't provide any adult supervision. They became cheerleaders.
The government policy was home ownership is a good thing, not just buy one home, buy a holiday home, buy a Section 23, buy a Section 50 student home, whatever, and buy property as your pension, buy for your children. And this belief or ethos was pervasive in society, and the government, they pushed this.
What happened in Ireland is the political system got captured by the financial system and by the property developing system.
The government was the most significant beneficiary. I mean, if you look at the returns on stamp duty, VAT on property, I mean, and a new house, effectively the government gets 41% of the purchase price between VAT and taxes paid on those who built it and things like that. So the government had a vested interest.
Soaring revenues in the bubble years allowed the government to increase spending and cut tax at the same time. It was a populist formula that guaranteed political success, while the inevitable consequences were denied or ignored.
They were getting huge dividend. They were getting power. They were actually getting political power as a result of the property boom. It's an extraordinary thing to realise now, but that's what was happening.
That political model that Bertie Ahern evolved to brilliant electoral success while he was Taoiseach was that the leadership of the country was about maintaining power for Fianna Fáil. Bertie Ahern's period led us to cast aside long-term, more sober policy development and thinking about the country's future.
Governments are there to make long-term decisions, and I don't think I was ever at a cabinet table, that deferred making the right decision.
But if right decisions were never deferred, what went wrong?
When governments do not get any of the warnings, governments are as good as they are, and their advisors and the people who are working with them. When there's no warnings given, governments can make mistakes.
So many commentators during those years were saying, this may not last forever, but it is going to last for quite some time, and when it goes into decline, it will take a soft landing. So what's the problem here? You'd be crazy to turn off the tap on this.
Do I take a personal responsibility or a collective one, as you have to under the Constitution and government, that there were some things that we could have done during that period that would have helped things, or that we could have ignored maybe some of the advice or ignored some of the criticism? Of course there are things. Was it right to bring in the tax incentives? Yes, it was. Was it wrong to keep them so long? Yes, it was. I have to say, one of the regrets I have is that I didn't stick with the residential property tax, which was deeply unpopular. If I had my chance again, I would have left it there and taken some of the heat out of it. But there wasn't much else, I think, that we could actually do.
The government was running the country, but the opposition wasn't urging a slowdown in the property market either.
To put the brakes on that would have required decisions which nobody in the political system was putting on the table at the time. No opposition party, and I don't want to try and share the blame, we were in government, but no opposition party was arguing that there should be credit restrictions on those who wanted to buy houses.
Easy credit created a feel-good factor that reinforced the established belief in the free market. So the banks who were lending the money were left to get on with it, in what was ultimately an abdication of political responsibility.
That's essentially the story of the last 20 or 30 years, that finance went to politicians and said, this is what we want. And politicians said, okay.
The pursuit of short-term interests by developers, politicians and bankers has left the country facing a bleak future. 450,000 out of work, 300,000 facing negative equity, and emigration back with a vengeance. On top of that, a bank bailout that some say could cost €50 billion and bankrupt the nation. How the country moves forward from here will depend on how past mistakes are addressed. The events of 2008 brought the world and Ireland to a stark realization. Big finance, set free from government regulation, has the power to do immense damage to sovereign states and national economies. And now, an apparent consensus. Tough controls must be imposed in the future.
Given that the sovereign state is left impaled on a hook when a bank threatens to go bust, it seems to me that regulation has to be very tight where banking is concerned.
We need regulation, we need appropriate authorities with only at heart and at stake the general public interest.
But taming the immense power that bankers and financial markets have amassed isn't proving easy.
It has become so complex, moving vast amounts of money around the world in the blink of an eye every second. A system like that is ultimately not capable of being regulated so that it behaves in a socially responsible way.
There is an extraordinarily big struggle going on. It's very unclear who's going to win this fight between the banking industry and the rest of society.
This is the make or break here, whether we really are willing to take bold enough action to really make the system significantly safer.
Financiers will just lie doggo for a little while and think that once this blows over, then they will go back to their bad old ways. So this is, the politicians will talk tough, it's a question of whether they act tough.
The appetite to take on this problem has got to be there, because if we forget about it or we just walk away from it, it'll happen again. And the next time it could be worse, really much, much worse.
History will judge this remarkable period in its own time. But one conclusion seems unavoidable. The great experiment of deregulating financial markets failed to deliver the sustainable economic growth it promised. Instead, dangerous credit and property bubbles emerged, along with a culture of greed and excess, where few became rich and many got into debt. The consequences of that failure suggest that the question for the future is not simply how should banks be run, but what sort of society should be created from the rubble.
Well, despite the country's cash crisis, some people are still willing to invest in what they deem to be business ideas that will deliver more than just paper profit. But would-be businessmen and women will have to convince these prospective partners of the cash flow potential when they go in front of the Dragon's Den next Sunday night at 9:30 here on RTE1. Coming up after the break, a directorial debut is discussed in The View.